Okay, last chapter. This is chapter 12, cash flow estimation and risk analysis. It's really capital budgeting. And so we're going to go through a new project analysis and a replacement project. We're going to skip the material on risk. So that's sections 12.5 and 12.6 in the chapter. You can just ignore those two sections, but we're going to cover the rest of it. So this is how we actually do capital budgeting. So in chapter 11 we learned the techniques, which are the NPV and the IRR, and now we're going to actually look at analyzing projects, and so we have to focus on the cash flows. So when we do capital budgeting, and again, capital budgeting are the big projects that companies evaluate to see if they want to invest, the focus is on incremental cash flows. Incremental cash flows means if we do the project, the cash flow will occur, and if we don't, the cash flow will not occur. And so what that means is, like, existing overhead of the business or existing employees of the business are not relevant to the decision. All of the focus is on the incremental cash flows that will occur if and only if this project is undertaken. Taxes impact cash flows, so we have to have an understanding of how taxes affect cash flows. And so we're going to learn to adjust all of the cash flows for the tax impact. Depreciation is not a cash flow, and so normally you would think that we would ignore it because our focus is always on cash flows, but depreciation is tax deductible. So the more depreciation you have, the more taxes you save, and so depreciation affects taxes, and therefore we're going to have to deal with depreciation and how it's calculated and the tax effect of the depreciation. So depreciation times the tax rate equals the amount of money that you save in taxes. For every dollar of depreciation you have, you save 35 cents in taxes, and that's a cash flow. And so if you look in your book at the end of the chapter in the appendix on page 435, there's what is called the MAKERS table, the Modified Accelerated Cost Recovery System table. And this is the table that's used to depreciate assets for tax purposes. In accounting, you probably use straight line depreciation, and I think I've probably mentioned before that companies keep two sets of books. They keep one set of books for the shareholders and a different set of books for the IRS. And so they use accounting methods that will minimize net income for the IRS, obviously because they're trying to minimize taxes. And they use accounting methods that will maximize net income for the shareholders because they're trying to look good. So MAKERS is an accelerated depreciation method that takes the higher depreciation deductions early when the time value of money is higher. So we're going to use MAKERS to depreciate because that's the depreciation technique that affects cash flows, not straight line. Okay? Financing costs are not included as cash flows because they are reflected in the weighted average cost of capital. So remember from chapter 10, the WACC is the weighted average cost of raising money. And so our cost of debt and our cost of equity are both reflected in here. So if we were to take dividends and interest and count them as cash flows, we would be double counting because it's by using the WACC as the hurdle rate in our analysis, we are in effect taking into account the cost of capital. So only incremental costs matter. I guess I said that twice because it's really important. Opportunity costs are real. Opportunity costs are sometimes hard to see and sometimes they're not, but an opportunity cost is what else you could be doing. And so if you are looking at turning a warehouse that you own into something, if you have an opportunity to sell that to somebody else, that's an opportunity cost, and it needs to be included in the analysis as to if this is a good project or not. This is a really hard one. Sunk costs are irrelevant. And it sounds easy, but in real life it's not. Sunk costs is money that has been spent in the past. And so when we lay out our cash flows for our analysis, the only cash flows we focus on are the incremental cash flows going forward. We can't unspend money that has been spent, therefore they are irrelevant to the analysis. And why I say it's hard is because lots of times companies will spend a lot of money on a project. They will do an NPV analysis and they'll decide it's a good project and they'll get going, and they'll spend a lot of money, and then get a little ways into it and find out that their forecasts were wrong, and that they, looking ahead now, they realize they are never going to achieve the forecast that made this a positive net present value project. But they've already spent $15 million, and so they don't want to cut the project because that would make them look really stupid. But the fact is, a negative net present value project isn't going to get better by spending more money. And so sunk costs are irrelevant and need to be ignored in the analysis. So a dollar saved is a dollar earned, and that is that savings. If we are looking at a project that's going to save us money, a dollar saved is equivalent to a dollar of revenue. And so we treat savings just like revenue. Revenue, expenses, and savings are all affected by taxes. If you earn a dollar, you're going to have to pay taxes on it. If you spend a dollar, it will be a tax deduction, and if you save a dollar, you're going to have your taxes will go up because you are saving money, cutting expenses. So all of those are affected by taxes, and we have to adjust them for the tax effect. Working capital is the net investment in current assets, net of any increase in current liabilities that happens when we take on a project. And the thing about working capital is that it's reversed. So at the beginning of a project, we would have to increase inventory, for example. And so that's an increase in current assets. That's a need for money. But if we can finance most of it on accounts payable, then we want to subtract that accounts payable from the inventory, because then we only have to come up with a smaller amount of cash. But so if you think of the cycle, so we invest in inventory, that's a cash outflow. But then we sell the goods and we use that money to buy the next round of inventory. So we don't have to inject any more cash into the business. The selling of the goods is going to provide the cash to buy the next round of inventory. All of our projects have an end, and so the question is, so what happens to that money when the project ends? And the answer is, it gets released back into the business. So the last time we sell the goods, if the project is ending, we don't have to buy any more inventory, and so that cash comes back to us. And so technically, working capital is typically a cash outflow at time zero, and then it's an inflow of equal amount at the end of the life of the project. Okay, salvage value and tax effects, we'll talk about that. The salvage value is when we sell an asset at the end of the project, and then there are tax effects if there's a gain or a loss on the sale of the asset. And then externalities are any things that this project might impact the company. For example, this is not a great example because it's not really costing us anything, but we have a campus in Norcross, which, for those of you that don't live in the Atlanta area, Norcross is about 35 miles from Gainesville. It's just north of Atlanta. And then halfway between Norcross and Gainesville, we're just opening another campus at a hospital, or a osteopathic college, in a town called Swanee. And so the idea is that we will appeal to more students. There's a city there called Lawrenceville and Swanee, a big population. So the idea is that our Swanee campus is going to be closer to that population center, and so it will attract new students. But undoubtedly, it will also steal students from both the Gainesville and the Norcross campus, because it will be closer to them. And so that's an externality. If we open this campus, and if all we do is steal students from Gainesville and Norcross, then in fact we haven't gotten any benefits from this. And if there were costs, it would be negative net present value. So we would want to include in the analysis the students that they lose in Norcross because they're no longer going there. So that would be like a negative revenue from Norcross that would offset the positive revenue in Swanee. So that's what an externality is. So this is the integrated case on page 430, and we're going to use it to demonstrate how to do a net present value analysis. Now, if you look at that integrated case, you're going to go, oh my God. But so you want to remain calm, and the art of this is being able to read through this. And so this just takes practice, practice, practice. You want to work as many capital budgeting problems as you can, because they're all the same. And so you want to get to the point where you go, that's the cost, that's the working capital, I know what to do with depreciation. So you might want to open your book to page 430 and kind of follow along there and look at all the words, but this is kind of a synopsis of what those words say. So this company is looking at expanding into the fruit juice business with a new fresh lemon juice product. And it's going to cost $200,000 to buy the equipment to do this product, and it's going to cost $40,000 to ship it and install it at the plant that they work at. Changes in operating working capital: inventories will rise by $25,000, accounts payable will rise by $5,000. The effect on operations is they forecast that sales will increase by 100,000 units a year, and it costs $2 a unit for this product, and variable costs are 60% of sales. The project has an economic life of 4 years and a depreciation life of 3 years, which we will see it takes 4 years. Salvage value of $25,000, tax rate 40%, and the WACC is 10%. This basically, these two slides, is the information that is in all capital budgeting problems. They are all the same. And so you just look for that information so that you can fill out your timeline and figure out what's going on. Now, I want to point out this right here. Economic life means how long the project actually is going to last. Depreciation life is the maker's class life that we have to depreciate this asset over. With maker's depreciation, the government has told us, the IRS has told us, if your asset is a truck, you're going to depreciate it over 3 years. If your asset is a building, you're going to depreciate it over, 10 years. So there's no guessing. It's all specified what kind of assets are depreciated over how long. So the structure of a capital budgeting problem is that you want to lay out a timeline like this, and you want to either do it in Excel or you can do it on a piece of paper and use your calculator. It doesn't matter. But so you're going to lay out a timeline, and so what you're doing is you're placing all of that information on those two slides into this timeline. So what's happening at time 0, what's happening in year 1, year 2, and so forth. And then is there extra stuff that's happening at the end of the project, and those would be called the terminal cash flows. So let's look at your time 0 first. Okay, so we said that the equipment was going to cost $200,000 and $40,000 to install it at the place of business. Now, time 0 is today, and then the time between time 0 and 1 is year 1. Okay, so time 0 is a point in time. So we're going to spend $240,000, spend negative, at time 0 to buy the equipment and get it up and running. And then we are also going to have a $20,000 change in net working capital. So remember, the inventories were going up by $25,000, but accounts payable paid for part of that, $5,000. So we only have to come up with $20,000 in cash. So that's an extra outflow, an investment in working capital. And if it helps you visualize inventory, I have to buy inventory because that's really easy to visualize. Then that's clearly an outflow. I'm going to need to come up with an extra $20,000 in inventory to get this thing going. So my time 0 cash flow is negative $260,000. The cost, the installation, and the net investment in working capital. Okay. Now, the depreciation. When we look at this, what is depreciable? Any money that you spend to get equipment to your place of business and up and running becomes part of the cost of the asset. So it's not just the $200,000 that's depreciable, it's the whole $240,000 to get it up and running. Working capital is an expenditure on inventory. That's not a depreciable activity. So we call that the basis. The depreciable basis is $240,000. Maker's 3-year assets are depreciated over 4 years. Maker's 5-year assets are depreciated over 6. And all I can tell you is that, amazingly enough, the Maker's depreciation schedule is the result of a negotiation. Tax policy is set by Congress, and accelerated depreciation is a way to stimulate investment. If you give companies bigger write-offs early, they will invest more. But then people said, yeah, but what if somebody buys an asset on December 31st? Do they get the whole big depreciation deduction in the first year? And so the compromise is that instead of getting the biggest deduction in year 1 like you should, you only get, see, this should be, I guess, well, it should be greater than 45. I'm not sure exactly what it should be. But so you get something less, and then you get the rest of it here down in year 4. So even though it's called a 3-year asset, it's written off over 4 years. So the depreciation rates for 3-year asset are 33% in the first year, 45 in the second year, 15 and 7. Obviously these things add up to 1 because you depreciate the whole asset. So each year you just multiply the rate in that year times the basis. So our basis was the total cost of $240 times 33%, so our depreciation expense in year 1 is $79, in year 2 it's $108, 36 and 17, and again these guys have got to add up to the cost of the asset because we're writing off the total cost of the asset. So I'm going to show you how they do it here, which I think is really cumbersome, and then I'm going to show it to you on an Excel spreadsheet, but I do it the way my Excel spreadsheet is set up no matter if I do it by hand or not. So this is called the income statement approach, and the problem with this approach, A, is it's long, and B, we don't always have all these things. We don't always have revenue, for example, and so it's hard to make an income statement if you don't have revenue. And so I really like my approach better, but I'll go through their income statement approach. So these are the operating cash flows each year. So remember it said revenues were going to go up by 100,000 units at $2 a unit, so that's $200,000 a year, constant. And they said operating costs are going to be 60% of revenue, so that's a negative 120 because those are costs. The depreciation we just figured out in the last slide, so that's a deduction, which lowers our taxable income. Taxes are 40%, so we get EBIT, multiply it by 40% to get the taxes here. And then we get EBIT times 1 minus T, or NOPAT, so EBIT minus the taxes. Note what's going on here. So we've got actually a loss in this second year because of the big depreciation deduction, and so we've got a negative 28 minus a negative, or in other words, a plus. If we lose money, we actually get a refund of taxes paid, and so this would turn into a minus a negative or a positive number, and it reduces our loss to 16.8. Okay. Then we want to add back depreciation because we're after cash flow, we're not after earnings. So we calculate our EBIT, take out the taxes, and then add back the depreciation to get the cash flow. We had to subtract it because it affects our taxes, but then we want to add it back in when we're done. Then we have what we call the terminal value cash flows at the end of the project. So we're going to sell the salvage value, or sell the asset for $25,000. The asset was depreciated over 4 years. So Makers depreciates it down to 0 over the 4 years. So we always have to see, is there a gain or a loss on the sale of the asset? And so in this case the answer is no. The book value is 0. Well, yes, there's a gain. The book we want to compare the market value or salvage value to the book value. So the book value is whatever we're still carrying it on our books at. And when I show you my Excel slides, you'll see what I'm talking about. But so the salvage value is $25,000, and that's the market value. That's what we can sell it for. So that's a cash flow. The book value after 4 years is 0, so we've got a $25,000 gain, right? 25 minus 0 is 25. So the whole thing is taxable. So we have to pay 40% tax on that salvage value, which is 10, and so the after-tax salvage value is only 15. And then remember what I said about the working capital. The working capital is freed up to be used in the company again, so that $20,000 comes back to you. So in addition to the operating cash flows in time 4, we have this additional $35,000 of non-operating cash flows. Okay? So then we put it all together on our timeline. So this was our negative 260 at time 0, and then these were the operating cash flows that we calculated. And then this is the operating cash flow in time 4 plus the 35, so it's 54.7 plus 35 is equal to 89.7. Okay? And so this is the hard part right here. The next part is nothing. So we've put all the cash flows where they belong on the timeline. And then we just enter them into the calculator or into Excel. So if you're using your calculator, we've got cash flow 0, 1, 2, 3, 4. The WACC is I, so the interest rate is 10%, and the NPV in this case is negative 403 because the internal rate of return is 9.3. Okay, so what does this mean? It's a negative net present value, so that means that this project does not recover the cost plus 10%. okay? And in fact, this project only earns 9.3%. It recovers the costs and a 9.3% return on investment, but we want a 10% return, so it's negative net present value, okay? So these two things always go together. If the IRR is less than the WACC, the NPV will be negative. If the IRR is greater than the WACC, the NPV will be positive. And remember what we said in Chapter 11. NPV is just money. In this case, these are thousands. And so this is $4,000. Well, this is negative $4,000. So clearly, negative $4,000 isn't something you want to do. Okay? Now, here's my much cleaner analysis that I like a lot better. And what I'll do is I'll go ahead and I will post my Excel spreadsheet that I got this from underneath the lecture on the module, so that you can go in the cells if you want to look at it. But this is a really nice looking analysis that I would like you to try and make your spreadsheets look like if you do it in Excel. So let me talk just for a second about good spreadsheet design. Good spreadsheet design puts all the inputs up here in an input box, and so I've put my costs, 240, the sales, working capital, operating costs, salvage value, tax rate, WACC. Those are all the variables to my problem. And so when you look in these cells, you're going to see references up here. I don't type any numbers down here. Everything is pointing either here or here. So I've laid out my timeline. And so you remember in time 0 it was 240 for the cost and 20,000 for the working capital, so we have negative 260, and I'm using the sum feature here. Now here's the difference. I don't do the income statement approach. I look at each individual item and I say, is it taxable or is it not? And I forgot to write 1 minus T here, but so if you make money, you are going to have to pay taxes on those extra sales. So instead of making 200,000, it's 200,000 times 1 minus T. So the after-tax amount of the sales is 120. If you spend money, it's going to lower your taxable income. And so the same logic. It doesn't really cost you 120,000. It costs you 120 times 1 minus T, or 72,000. So the costs save you taxes because they're tax deductible. So your costs aren't as big as you think they are, but your revenues aren't as big as you think they are either. Okay. Now the depreciation. So here's my depreciation rates up here, and I've multiplied them by the 240. So we already got this part. Depreciation in the first year was 79.2, 108, and so forth. And so just to make myself happy that I'm doing this right, and sometimes because we need these numbers, I've added a book value line here. And so what this is 240 minus 79.2 is 160,800. So this is what the asset would be on the balance sheet after the first year. Then in the second year, we're going to subtract 108 from that, and so after 2 years, the book value will be 52.8. After 3 years, it'll be 16.8, and so the check is, it's got to be 0 after the full year of the depreciation. Now, sometimes, read probably on the final, we're going to dispose of the asset after 3 years. And so if we did that, the asset would have a book value of 16.8 after 3 years. So we would have to compare that 25,000 and say the market value is 25,000, the book value is 16.8, and so I only have a gain of, what is that, $8,200? And so only the gain is taxable. So I would multiply the gain by the 40% to get the amount of the tax. And I'll work a problem like that so that you can see it. But so it's good to create this little chart up here just so you know what's going on with your depreciation. This line then is depreciation times T. Depreciation is not a cash flow, so there's no dollar that goes out the door for depreciation, but it saves me 40 cents for every dollar that I have. So this is the amount of the depreciation times the tax rate. This is how much money I save by having depreciation, and that's a positive cash flow. So I've put it down here. And then there's my salvage value and my tax, and I add them all up. But so you can see, I just like my way a whole lot better, because sometimes there aren't any sales, or just something's missing and you don't always have enough information to make an income statement. But so doing it this way means you need to understand that sales are 1 minus T, costs are 1 minus T, depreciation is T because there's no dollar going in or out the door, it's only an accounting entry. Okay, and here we figure the tax on the salvage value as a separate line item. And then note also the $20,000 in working capital that came back. When I construct these problems, the moment I put negative 20,000 here, I say, there it is coming back. I put it down right then so I don't forget it. And then I calculate my net present value, and I didn't do the NPV because I was going to demonstrate it, but now I'm not. So, how is net operating working capital recovered? I already said that, but so it's when the project ends, the last time you sell your merchandise, you don't have to reinvest it. So it becomes available for some other use in the business, so it really does come back to you. Is there always a tax on salvage value? No. If we sold the asset for its book value, there would be no gain or loss and thus no tax. Is the tax on salvage value ever a positive cash flow? Yes. If you sell the asset for less than its book value, you're selling it at a loss, and that gives you a tax credit, just like losing money gets you a tax credit. Should the financing effects be included in the cash flows? No, because they're in the weighted average cost of capital, and I already talked about that. Should a $50,000 improvement cost from the previous year be included in the analysis? No. This is an example of a sunk cost. And so the fact that we spent $50,000 cannot be changed now, so it's not incremental to this analysis. So this is an example of a sunk cost that should be ignored. It is not incremental. If the facility could be leased for $25,000 per year, should that be included in the analysis? Yes, and this is an example of an opportunity cost. So if we leased it out for $25,000 a year, that would be revenue, so we'd have to pay taxes on it. So our after-tax revenue would be $15,000, and so we would include this as a negative cash flow in the analysis. This is money we could have gotten. We've chosen not to by doing this project, and so we want to make sure that we include that as an opportunity cost, a physical negative cash flow in the analysis. If the new product line decreases the sales of the firm's other lines, this is an example of an externality that I was talking about, like with our campus, and so we want to include that as a negative cash flow in the project. Okay, externalities can be positive in the case of complements or negative in the case of substitutes. Okay, replacement is like an expansion of this analysis, and I will do an example of a replacement problem separately. So I'll wait and talk about that then. Okay, this is what happens if we have projects of unequal lives. Excuse me. And bottom line is you can't just calculate the NPV and compare these. So the situation here is they're mutually exclusive, so you buy one or the other, and they'll be repurchased. So the point is that you need what this machine does all the time. So if we calculate the NPV A is higher than the NPV of B. Well, if we look at it, it's because it's got more cash flows. And so it's not really a fair comparison. So there's two ways that we can deal with this. We can calculate a replacement chain, or we can do an equivalent annuity. So the replacement chain says, okay, if we look at this, 2 B's is equivalent to 1 A, right? 2 B's will get us through 4 years. So if I lay my cash flows out on a timeline, my cash flows for B for the first year are this, and then I'm going to do it again the second time around. So in year 2, I'll get my $27,500 coming in, but I'll have to buy another B, and then I'll get a $34,000 and a $27,500. And so if we find the NPV on this whole string of cash flows, it's $66.41. And so it turns out B is actually better than A when we put them on an equivalent life. An alternative way, when this works anytime, but it works especially well when the project lives are like 6 and 9. And I don't know, the lowest common denominator life there is probably 54. So if that's the case, what you can do is you can convert the cash flows to an annuity. And so the NPV for A was $54.7265, and it lasted 4 years. And so if we put that into our calculator and say the present value is the NPV, interest rate is 10, and N is 4, and solve for payment, what we're saying is $54.72 is equivalent to an annuity of $17.26. And for B, 3636 was over 2 years, and if we solve for payment, that's equivalent to an annuity of 2,095. So if you're going to be recycling this over and over and over, then the one with the higher equivalent annuity is the better project. And so that's the same as the replacement chain, okay? Now, in the project that we did, we ignored inflation, and that biases our NPV down. If you remember all the way back to our chapter on interest rates, R is equal to risk-free plus expected inflation, right? So all interest rates have inflation built into them. So that 10% WACC that we're using has an inflation adjustment in it. By ignoring inflation in the cash flows, we're basically discounting at too high of an interest rate. So here is the same problem adjusted for inflation. So we inflated the cash flows at 5%. So each of these are growing at 5%. Depreciation doesn't grow, that's fixed. So it's just the revenues and the costs that grow at 5%, but look what happens. When we inflate our cash flows, it turns out this is a positive net present value project, and the IRR is 12.6. So ignoring inflation is potentially very dangerous. And so you either take inflation out of the discount rate and discount at real rate of interest, or you put it into the cash flows, and that's the most likely way to do it because it's easy to inflate the cash flows, especially if you're doing this in Excel. So if we incorporate inflation into our analysis, this actually turns into a good project. Okay, so I'm going to post, and I'll go over the Excel spreadsheet on this, and then I'll do a replacement problem besides.